Good morning all, and thank you for joining Techstep's Q1 presentation. My name is Børge Astrup, and together with our CFO, Solum, we will take you through the operational highlights of the quarter and the financial results. Techstep is a purpose-led organization designed to help customers with smarter mobile technology. By making the world of work smarter and more sustainable through mobile technologies, we make positive changes to the world of work, freeing people to work more effectively, securely, and sustainably. To have a clear vision and mission is critical, and is our guiding star in everything we do in Techstep. From developing software solutions, attracting talents, developing our organization, winning new customers, and delivering high value to our existing customers and stakeholders. Techstep is a mobile technology company that helps customers to utilize their software and hardware. We are the only mobile technology player in the Nordics that can deliver managed mobility, including software, advisory, and hardware. We have solutions for those that work in an office and those that work out in the field, also known as frontline workers. We have some of the leading consultants in mobile technology in the Nordics and perhaps in Europe. In Q1, we have continued on the journey towards turning Techstep profitable. We will turn Techstep profitable by selling the new simplified product portfolio to existing and new customers and delivering on our cost optimization program. The net gross profit development in Q1 was stable as guided in our last quarterly presentation. The recurring revenue base continued to grow with 15% compared to the same quarter last year to 312 million, of which 130 million is from our own software. So let me take you through some of the highlights for Q1. Techstep financial results are still not in line with our ambitions, but moving in the right direction as we are working hard on finalizing the transformation and the cost optimization. The recurring revenue base continues to grow, both year-over-year and quarter-over-quarter, while the net gross profit in Q1 is stable. Total recurring revenue is growing in Q1 with growth in all three areas. 24% growth in own software, 15% growth in advisory and services, and 14% growth in hardware as a service. Approximately 1/6 of our customers has a recurring service from us, so still a significant upsell potential. The ARR from own software grew to 113 million and are in line with our strategic objective to lead with software and scale with recurring revenue. For the second consecutive quarter, we delivered a positive EBITDA adjusted of 4.1 million, as the cost optimization is filtering through with an 18% decline in operating cost and salaries. With winning the frame agreement with Sykehusinnkjøp, the commercial momentum continues. The contract has a potential of 650 million in revenue, whereas 400 million in hardware and 250 million in software and advisory and services. This is to be delivered over the next 4 years. This shows that we have significant traction in the public sector with our offering. There is an increased interest in our smart control offering with proactive managed services, and which has contributed to 2 large new contracts of 2.1 million in recurring revenue. But at the same time, we see that the private sector are more cautious with slower conversion from sale than anticipated. In Techstep, there has been a high tender activity in Q1. Multiple of tenders has come out and are asking for lifecycle solutions, support on managing the mobile ecosystem and also the hardware. This is a perfect fit for us, and we have prioritized our resources likewise. The effect of the tenders is expected to be seen later this year. 2023 is all about execution for Techstep. We execute on the final phase of the transformation. We have gone from being a hardware company to a software and service company, where we help customers to be able to utilize mobile technology. The status is that our recurring revenue is growing, and we continue to have a focus on delivering value to our customers. And during Q4 2022 and Q1 2023, we have successfully launched new products in our three portfolios of Smart Device, Smart Control, and SmartWorks. We have had some launch delays, but due to reprioritization of resources toward tender requests. We also execute on the cost optimization program with clear focus on turning Techstep profitable. Last year, we announced a cost optimization program to reduce the cost base with 90 to 100 million. The status after Q1 is that we are on track. The final restructuring of the employer base and also the cost focus across the organization. We will have a continued focus on rationalizing our cost base during this year. When we talk to organizations, there are three challenges that they have with the mobile technology area. 1, the lifecycle management of devices. 2, managing the mobile ecosystem and security. And 3, increase the efficiency, quality, and the safety for their frontline workers. What we now deliver to the market solve these challenges in a market with a strong growth. Smart Device solves lifecycle challenges for organizations, from purchase to service and reuse of mobiles. The solution gives the employees the freedom to choose, and the organization has control of their cost, and they can save from 4,000 to 10,000 per employee. Smart Control helps customers to have control over security, apps, handling of data, and also the interaction between other IT systems and the mobile ecosystem. SmartWorks is a solution for employees who do not sit behind the desk, where they can increase the quality of their work significantly more effective, and also makes the employees more happy and produces better results. Our portfolio consists of both recurring and transactional revenue, where recurring revenue is recurring contracts with a minimum 12-month commitment and includes running agreements on advisory and services, hardware, and also own software. Own software is also referred as ARR. Transactional revenue is one-time revenue on advisory and services and hardware. Recurring revenue creates stickiness, and stickiness creates better scalability. With the new Simplify offering, training of the employees also becomes faster and more precise. The product portfolio is designed to drive upsell and give customer increased value. The majority of organizations are at the first step, where they have rolled out devices to their organization. The portfolio is designed so that customers can start with a solution that solves their challenge. Like Videre Ground Handling, they started with Smart Control. Customers that buy all three portfolios are the ones that get the most value out of our solutions, and they are also the most satisfied customers. Increased value for the customers means higher profit for Techstep and increased shareholder value. Smart Control is a recurring managed service where Techstep's experts deliver best practice implementation, support, and proactive services. By combining software and advisory and services, Techstep manage and secure the entire mobile ecosystem for customers. This ensures that customers' devices and apps always are compliant, secure, and up to date. As mentioned on the previous slide, managed services is a recurring service, and it's designed to drive demand and to deliver great customer value. With growing security threats of mobile devices, the Smart Control portfolio has a promising position towards the marketplace. As mentioned, the first quarter was tender heavy. With several large tenders delivered, it's great to see that this materialized with winning the frame agreement with Sykehusinnkjøp, covering 40 hospitals and 300,000 employees. With the agreement, we will be the exclusive provider, and in cooperation with the regional healthcare IT, we will digitalize the hospitals through mobile technology with delivering of all our portfolio. The potential value of the contract is up to 650 million over 4 years, including software, advisory and services, and hardware. This is estimated to approximately 400 million in hardware and 250 million in software and advisory and services, with the potential of doubling the current contract value. The agreement will be deployed in Q3 2023 and onwards. We thank Sykehusinnkjøp for their renewed trust and look forward for the cooperation. I will now hand over to Ellen Solum, who will take you through more details of our financial results for the quarter.
Thank you, Børge. I'll take you through some key points in the financials. As Børge pointed out, this year is all about execution, delivering on the investments made, and beginning to benefit from the cost optimization initiated in 2022. Transformation takes time, and Techstep has been through a long journey. We're very happy to see that we are finally able to see the results filtering through in our financials, and that we are on our way to make Techstep profitable. As we are not yet quite there, we continue to focus our efforts on the ongoing transformation to secure the platform for growth based on a much lower cost base than we have seen in the previous years. Total revenues in first quarter was 292 million. Compared to first quarter last year, we see a decline of 16%, which is entirely due to a downturn in the hardware turnover. As we focus our sales effort towards tenders and opportunities where we see possibilities to upsell from our complete solutions, including software and services, we are not chasing deals and tenders where we see run to the bottom margins. This will affect our revenues going forward, but we expect to increase our gross profits as we move towards higher margin sales and convert our customers to recurring revenue models. Despite the decline in revenues, our net gross profit year-over-year declined with only 3%, but with a 4 percentage point increase in margin to 31%, as the share of higher margin revenue streams are increasing. ARR from our own software increased with 14% year-over-year, reaching 113 million at the end of the quarter, a growth of 2% sequentially, and in line with our expectations for 2023, where we are assuming a more exponential growth towards the end of the year as we continue to roll out the new product portfolio and implement the new agreements won in the first few months of the year. In the first quarter, our EBITDA adjusted improved with 14 million year-over-year, which is a result of reducing personal costs and other operating costs with 18% compared to first quarter last year. Going out of the quarter, we have established a new baseline for operating costs going forward, but we are continuously focusing on further cost reduction possibilities as we work with streamlining the organization without impairing our go-to-market efforts. Techstep is still showing a net loss, but the entire loss this period is due to non-cash effects such as amortization of intangible assets and non-realized currency effects on balance sheet items. One of the new operating metrics introduced in third quarter last year was net gross profit, which we believe is a better measure of our underlying profitability. As our hardware as a service business falls under the IFRS 16 accounting principle on leasing, cost of goods related to these revenues are booked as depreciation instead of COGS. We therefore use net gross profit, which includes the depreciations related to our hardware as a service portfolio, as a profitability metric. In the first quarter this year, we see a relative flat and stable development in our rolling 12-month total net gross profit. However, the mix in revenue streams is changing in line with our strategy. Gross profit from our own software increased 6% this quarter and 24% since first quarter last year. Advisory and services are showing a slight improvement of 2% the last quarter, in line with the underlying organic growth in previous quarters. The decline up to the fourth quarter last year shown here is due to the divestment of our voice and contact center in the fourth quarter of 2021, impacting the 12-month rolling gross profit in 2022. Gross profit from our hardware business is declining as we focus our efforts on higher margin recurring revenues. We are continuing the growth in our own software portfolio. Through acquisitions in the period up to 2021, we acquired solutions that we have refined into a current solid IP portfolio. And as we have communicated, this is where much of our future growth ambitions lie, and it is a key element in our upsell steps that Børge showed previously. At the end of the first quarter of 2023, we had ARR on own software of 113 million, which is a 2% growth in the quarter and 15% since the end of 2021. And this growth is entirely organic. We have ambitions to grow even further for the rest of the year, expecting to reach 140 million in ARR at the end of the year, as we transition to the new platform for our hardware as a service customers, and as we implement newly won contracts. The ARR reported that we show here is extrapolated based on actual contracts invoiced in the period, not on contracts won, but not invoiced. As such, the agreements and tenders we have won in the first quarter will materialize in our ARR reporting when invoiced later in the year. Techstep has currently over 2,000 customers, of which only about 200 plus are on a recurring revenue model. As Børge showed previously, our model is designed for upsell to our existing customers, and with this substantial customer base coupled with our solid IP portfolio offering, we believe that our ambitions to reach 225 million in ARR in 2 years is valid. And as we can see here, from the growth in our recurring revenues the last quarters, we do succeed in converting our customers to recurring models. We have increased our recurring revenue base with 15% year-over-year in the last quarter, and we have grown the revenue with 3% sequentially. While we in the previous quarter showed a flat development in hardware as a service and advisory and services, we now see an increase also in these revenue streams in addition to ARR on own software. Although we did see some churn in hardware as a service in the previous quarter, as some customers residing on the old platform switched to transactional purposes, the growing activity we see in the public sector is driving the growth in the hardware as a service recurring revenues. But we're also pleased to see that revenues from our advisory and services grow with 3% sequentially. This revenue stream includes a large part of our managed services offering, where our margins are significantly higher than for hardware as a service. Our conversion from gross profit to EBITDA is showing a positive trend over the last few quarters. As Techstep divested the voice and contact center business at the beginning of 2022, while Famak was acquired in the second quarter of 2021, we provide visibility by showing our pro forma figures for these periods. The voice and contact center business was seen as a non-core asset, but it did include 22 million in gross profit in 2021. The top graph shows our quarterly performance on a pro forma basis. Our first quarter net gross profit declined with 10%, but our conversion to EBITDA improved from 2% to 4% sequentially, and with 15 percentage points from the first quarter last year. This improvement is due to the cost optimization program we launched in 2022 and which we have delivered on during the winter. We now see the cost savings coming through in our financials, and first quarter of 2023 is our second consecutive quarter with positive EBITDA adjusted, reaching 4.1 million. The graph below shows the trend over the last 12 months period. The declining trend in EBITDA conversion during 2021 and into 2022 was highly impacted by both hardware delivery issues, investments in our technology platform, and transformation towards a recurring revenue model. Since second quarter in 2022, the trend has turned, and we have continuously improved the EBITDA conversion rate from -13% in Q2 2022 to -3% at the end of first quarter this year. The investments we have made over the years in our products and offerings have resulted in a highly scalable model, and our 2025 goal is a net gross profit conversion rate above 25%. The cost optimization plan that was announced in the third quarter last year indicated that we would be downsizing the organization, cutting costs and investments to reduce the cost base with 90 to 100 millions. In 2022, our total cost base was 442 million, which included all costs for employees that were affected by the restructuring and with limited impact from the cost optimization plan. At the end of the first quarter, we have implemented the majority of the initiatives. We have reduced our headcount substantially, our marketing, admin spending, and consultant use is down, and we have reduced the level of investments in our technical platform. We are now running towards an end-of-year operating cost base in line with our previously communicated target of 359 million, including CapEx spending. Although we are very pleased to have delivered on our plan, we are focusing on ensuring a high level of cost awareness in the organization. And as we continue our work to integrate entities, rolling out common IT systems and processes across the group, we will also continue to optimize our cost base without impairing our sales and delivery efforts. Moving on to our balance sheet at the end of the quarter. We have an equity ratio of 47%, up from 43% at the end of the year. The increase is due to currency effects on the ownership in our foreign subsidiaries. Our intangible assets of 812 million primarily consist of purchased goodwill, customer relations and technology of 738 million, in addition to own capitalized investments. The change from last year is due to currency conversion effects and additional capitalization of own development of 10 million in the quarter. Tangible assets consist of capitalized hardware as a service to customers of 153 million, which is capitalized according to IFRS 16. In addition, we have right-of-use assets, which is primarily related to office rental contracts. Our current assets of 230 million is mainly trade receivables from our customers, and we had 34 million in cash at the end of the quarter. Our total interest-bearing debt was 187 million, whereof 80 million was classified as long-term. Our interest-bearing debt consists of bank loans related to acquisitions, sellers' credits, and general bank credit facilities. Interest-bearing debt has increased with 13 million since 2022, which is a result of down payment of loans offset by increase in short-term credit facilities. The net interest-bearing debt was 112 million at the end of 2022 and is now at 152 million. Out of other current liabilities of 290 million, deferred revenues and buyback obligations related to our hardware as a service portfolio was 169 million. Although our EBITDA in first quarter in 2023 was positive, the quarter was quite capital intensive as the majority of the cash effects of the cost reductions will occur from second quarter and onwards. The operating cash flow in the first quarter was minus 2.7 million, including a negative change in working capital of 32 million, which is 15 million higher than first quarter last year. As the effects from the cost optimization takes place during the rest of the year, we expect to see a gradual improvement in operating cash flow. CapEx related to software developments and IT investments was 11 million in the quarter, down from 19 million year-over-year. And investments in the hardware as a service portfolio was 16 million versus 31 million last year. In the first quarter, 20 million was used to repay acquisition loans and sellers' credits, while approximately the same amount was drawn on credit facilities. In total, cash and cash equivalents decreased with 29 million during the quarter, ending at 34 million. Then I'll send the presentation back to Børge, who will give you some closing remarks.
So, let me summarize. Our key focus is to turn Techstep profitable, and all in all, we are on track. There are some uncertainty in the macroeconomic environment that has resulted in somewhat longer lead times and a bit more cautiousness on the customer side. We are at the final phase of the transformation, where we continue to simplify our product offering. We have also successfully launched new products and are growing the recurring revenue base. We are on track with the cost optimization program, with the final restructuring of the employee base and continued cost focus across the organization. We have a strong focus on delivering on the company targets for 2023 and 2025, with the goal of delivering more than 540 million in gross profit, more than 225 million in software ARR, and more than 150 million in EBITDA adjusted in 2025. And that concludes today's presentation. Thank you for your attention. And please join Ellen and myself in the Q&A session today at 8 o'clock. You can always submit your questions to us by using the investor relation email address or during the session using the chat functions. Hope to see you there soon.